This is Jeremy Wentworth Stanley. I'm the fellow who has a hyphen in my name. The hyphen is silent, but I am anything but that. Respectonomics is bringing you Living Economics. Living Economics is the current update on what's going on in the world of finance and economics. This is May of 2026. This is also an extension or a second part to an earlier podcast, an earlier discussion in which we talked about interest rates. And we're going to continue the theme about interest rates for a couple of reasons. One is because when you talk about a major component of the economy, in this case interest rates, it often happens that there are people who will call in and say, have you thought of? So there's always other dimensions. It reminds me a little bit about getting onto a train and you stop at a different station, and at the different stations, some people get on and some people get off. And economics is much the same, and more ideas come to the table, come into the carriage, if you will, and we're going to explore these different components that arrive and the ones that leave. My name is Jeremy Wentworth Stanley. I am your voice of Respectonomics. I am also the year of Respectonomics. The year means I hear and I listen, and I want to hear your comments. I want to hear your, what would you call it? Your insights. I want to hear where you agree or disagree. And disagreement is just fine. Nobody has a monopoly on good information. So, we're going to be talking about interest rates, and we were talking at our previous message, we were talking about the way in which interest rates are being raised, partly as a result of government loans, government borrowing, and then also talking about the way that prices are being moved up in relation to supply constraints. In other words, oil is not flowing as easily as it used to, and as a result of that, the price of oil is being raised. And the sort of so-called magical response to that is to raise interest rates. We contest that in the sense that raising interest rates, first of all, is not bringing new supply on stream, but also the other thing is it actually adds, it adds to the inflationary bias. However, we have three other things we want to talk about now. And that is interest rates from the standpoint of protecting or building up the value of a currency of a country compared with other currencies of other countries. And it's often thought that if you have a low-priced currency, so if you say the value of my currency has gone down, there's a certain amount of almost economic pride in that, because one says that means my exports will be cheaper, and it will encourage people to come and visit my country. The problem is, there are two central problems with a weak currency. And the first one is strictly economic. It means that the cost of inputs, particularly the ones that are imported, go up. So in a sense, a low currency has an inflationary bias to it. And the problem is that if the currency is low and then the inflation starts picking up, it tends to be self-perpetuating, because the more you import inflation, or the more you're seen to be importing inflation, then the more your currency is considered not to be as valuable, and it pushes it down. That's one problem. The second problem is this. Generally speaking, and it has been said, I think almost anecdotally, but I think there's a sense of justification. No country ever got rich or wealthy on the back of a weak currency. A weak currency is in fact a misappropriation of wealth. It's a sort of misalignment. And therefore, the kind of wealth you're talking about that results from a weak currency might even be viewed as being parasitical, whereas the kind of wealth that we're trying to create is one where there is added value, where there is a sense of symbiosis with other nations, and of course within one's own orbit, within one's own boundaries. So the point of the matter is that if we want to have a strong economy, we need to have a strong currency. I suspect that the two are a chicken and an egg. that if you have a strong currency, that attracts foreign investment because people think you've got your act together. On the other hand, if you have your act together, maybe that in itself attracts foreign investment. Chicken and eggs. But the fact seems to be, I shouldn't call it a fact, but it does seem thematically that a strong currency embraces and connects well with a strong economy. There's another part to this, though, and that is that when we look at the value of one's currency, it's also a sense of pride. It's a sense of we've got our act together. I think most of us would agree that when one's currency is low against another, let's say, major traded currency. So, for example, if you find that your currency is below that of, I mean, whether it's the US dollar or whether it's below that of the yen, whatever it might be. But when you have a low currency, it breeds a certain sense of dissatisfaction, a sense of low morale on oneself. A strong currency is something that breeds a sense of pride, a sense of objectivity, a sense of we can do it, a sense of good value. So, in other words, although this might sound more of a sort of moral commitment, the fact of the matter is that a strong currency does breed, does encourage this sense of self-worth and enthusiasm. The next thing we need to think about in terms of currency, we've talked about its inflationary bias or its ability to withstand inflation, and we are also talking about how it stands in our national psyche. But one of the other things about interest rates, having talked about currencies, we should also talk about another C, which is creditworthiness. And creditworthiness is an area that may be coming under, let's call it, under the microscope. We are evidencing today a rise in delayed mortgage payments, delayed installment debt payments. We've seen a rise in foreclosures. We're seeing all of those ticklers in the wind, which are tickling our sense that creditworthiness is declining. If you go back to 2007, 2008, one of the great travesties there was that the rating agencies were giving these AAA ratings where they simply weren't deserved. And I think we need to be able to look at our own ratings, not only in our own personal lives, but in our corporate life and our national life, and in a global sense, to think about, is the creditworthiness today better than it was a year ago, 5 years ago, or 10 years ago? And I think we will come back with a sense that creditworthiness today is not as good as it used to be. The volume of borrowing, the dependency on debt financing, the sense that there's a rise in the proportion of money that's being used in people's households or in fact nationally, the amount of money that's being used to pay for interest. All of these are ticklers in the wind that tell us that creditworthiness is probably declining. And that brings us to an interest rate formula, because when a credit is deteriorating, that predictably brings a rise in the interest cost. So we may be looking at rising interest rates beyond the simple or the practical issues of loan demand and inflation and all those other things. We may be looking at this through just the lens of creditworthiness. And the snag with creditworthiness is that if, as and when it is deteriorating, when the real crunch comes, that becomes a real obstacle because people are then literally, physically unable to pay off their loans or pay the interest. Which leads us to the third C. We've talked about currencies, we've talked about creditworthiness. We're now going to talk about a crunch. And the crunch is this. The crunch is that if we come into a time of these higher interest rates and declining creditworthiness, we need to look at what you might call the banking system. The banking system is predicated or works on the fact that a bank will have $100 worth of assets, which is typically cash that it has, together with the money that's owed to it, which is loans. So you've got the investments and the loans and the cash on the asset side. And then, of course, you've got the money that's been borrowed by the bank to fund the depositor's money, basically. And the net difference between those two is the equity of the bank. We don't have to get into huge capital asset ratio calculations, but the banks are leveraged. That's a practical truth. They have $100 worth of assets. In today's world, they have approximately $12 of capital. If you look at that relationship of, let's call it a 12% factor, and if you look at loans that are falling apart, if we say that in today's world that figure is running at around 5%, what if that figure goes to 10%? We can shrug our shoulders and say, well, there's 10% off the map. But we could also say that has a significant impairment, a significant destruction on the equity, on the net value, if you will, of the banking industry. And this is where you get the word crunch. Because when a bank believes, and certainly the regulators believe, that credit is the equity is being diminished, that is when with the banks get into this business of tightening up their credit systems. This is when they start saying, we are going to tighten up the credentials, if you will, of our borrowers. And that's when we get into what's called a credit crunch, or it's in more properly, it's called a liquidity crunch. But we could be coming into that. And take a liquidity crunch for a moment, because if we come into a time where the tap, the faucet of lending is being slowed down, it's being turned down, that in itself would tend to raise the price of money, which means the price of the interest rate. So I think we need to look at this interest rate phenomenon through a more cynical eye, a more objective eye, and think about recommending to governments, recommending to corporations, and of course recommending to us as the proverbial consumer, the individual, that this is a time to start pulling in the reins of indebtedness so that we do not find ourselves either dealing with a currency issue, a creditworthiness issue, or ultimately a crunch. I'd like to hear your opinions on this. We will continue with interest rate discussions, and we will continue with discussions and controversies on the movement of currencies and the movement of capital and the movement of tariffs and the movement of goods and so on. It's a never-ending subject. Certainly, we welcome your opinions, and we hope that this has been helpful. My name is Jeremy Wentworth Stanley, and I rest my case.